Many wealthy individuals have a different perspective on debt compared to those with fewer resources. While many individuals with limited financial means strive to pay off their debts promptly, the rich seek ways to increase their debt load. This concept may be disturbing to those who struggle to make ends meet with a lot of questions on their mind. Stay till the end of this video as we answer a few of the questions regarding good debt and bad debt. Why would anyone willingly take on debt, along with the accompanying interest charges? Wealthy people employ debt in various ways. Discover why many highly successful individuals prefer to be deeply immersed in debt, including mortgages, car loans, and various other financial obligations, rather than pursuing a debt-free lifestyle with no monthly commitments. You may have heard about two types of debt: good debt and bad debt. Bad debt involves borrowing money for expenses or items that drain your finances each month and depreciate in value. A car loan is often seen as a type of bad debt. This is because in most cases people borrow money to buy a car, which is an asset that loses value over time. Having this type of debt means they have to pay money every month, and to make those payments, they need to go to work and earn a salary. On the other hand, a good debt is when you use borrowed money to make more money. For instance, consider a mortgage for a rental property or a loan for a business that generates more income than the debt costs. With these kinds of debt, the income generated from the asset covers the monthly payments and even leaves some extra. Real estate investors are a good example. They don't mind paying interest rates of 6%, 8%, or even 12% on borrowed money because they know it enables them to make much more than that. A real estate pro might have a mortgage at 7%, but they could potentially be earning a return of 15 or even 30% on their investment or their own money put into the deal. Imagine a store manager who wants to start a new restaurant venture. It's no surprise that starting a business can be incredibly costly. There are numerous expenses involved, including renting or buying a space, acquiring equipment and furniture, purchasing inventory, covering insurance costs, and hiring staff. These expenses can add up to a substantial sum, making it difficult for aspiring entrepreneurs to save up the necessary funds. This leaves them with a challenging decision: wait for many years until they've saved enough money, hoping to outpace the rising cost of living, or take a business loan and start their venture much sooner. While opting for a loan means paying interest, it can be a worthwhile investment if the business is profitable. One benefit of taking on business debt is the potential tax advantage. Interest payments on certain loans can be deducted from your taxable income, effectively reducing the amount of income that is subject to taxation. For example, if someone has an annual income of $110,000 and they paid $10,000 in tax-deductible interest, their taxable income will decrease to $100,000. This doesn't mean they save $10,000 in taxes outright, but rather they're taxed on the reduced income of $100,000 instead of the initial $110,000. This tax deduction can lead to lower overall tax liabilities, which is especially valuable for businesses. It's a way to make the cost of borrowing more manageable and encourage entrepreneurs to invest in their ventures sooner, driving economic growth and job creation. While taking on debt should be a carefully considered decision, understanding its potential tax benefits can make it a more appealing option for those eager to pursue their entrepreneurial dreams. People don't typically take on debt solely for the purpose of deducting interest from their taxes, but it's certainly a valuable advantage. It allows them to use less of their own money and more from banks, enabling them to expand their ventures faster than if they relied solely on their savings. To illustrate, let's consider a hypothetical scenario. Someone has $100,000 to invest in rental properties. They face a choice between buying a single property outright for $100,000 or putting a 20% down payment on 5 different properties, each worth $100,000, and financing the rest through a mortgage. Opting to pay cash for a single property is undoubtedly the safer option. However, it may take a considerable amount of time to accumulate enough cash to acquire additional properties, even when considering the extra income generated from owning a property free and clear. By leveraging a bank's capital, the investor can stretch their money and potentially benefit from the appreciation of 5 separate properties. This approach also brings forth other advantages, such as tax benefits and the gradual reduction of the mortgage balance each year. In essence, leveraging debt allows investors to multiply their investments, seize opportunities, and potentially enjoy the growth of multiple properties simultaneously. While it involves some level of risk, smart leveraging can significantly accelerate wealth building and financial growth, making it a strategy worth considering for those aiming to expand their real estate portfolio and reap long-term rewards. The ability to expand applies to all business owners, yet it comes with a high level of risk when you use someone else's money. Borrowing means potential trouble in repaying debts. What if you can't manage those loans? Do you default and lose your assets? On the flip side, leveraging can lead to exponential returns far beyond what debt-free individuals usually earn. With higher risk comes the prospect of higher rewards. When you leverage funds, your investment outcomes become magnified, be they positive or negative. When things go well, they go very well, and when they go south, they go very badly. This isn't news to wealthy individuals. They recognize that using debt exposes them to a greater risk of losing money. However, they are adept at balancing risk and reward. They don't recklessly borrow for business or investments with a high likelihood of failure. They exercise caution. One way they mitigate risk is by acquiring assets at a discounted rate. The teachings of financial experts like Dave Ramsey work remarkably well for the average person seeking to build and preserve long-term wealth. These strategies emphasize debt reduction and conservative financial management. While the wealthy take calculated risks to achieve substantial gains, these approaches may not be suitable for everyone. Balancing risk and reward is the key, and understanding when and how to leverage debt sensibly is a skill that can lead to financial success. Following Dave Ramsey's financial strategies is a low-risk approach, but it comes with a significant drawback. It can be a slow journey to achieve substantial financial milestones. In fact, adhering strictly to his principles might mean it takes a lifetime to amass $1 million portfolio. Dave Ramsey does offer some valuable advice that applies to everyone, such as living within your means, a fundamental financial principle essential for success. However, many wealthy individuals do not blindly adopt all of his recommendations. Rich individuals evaluate Ramsey's guidance and question the wisdom of paying off debt with a low interest rate when they have the potential to consistently earn more from their investments than the interest costs. Similarly, they ponder why they should pay for a car in cash when they can finance it at a 4% interest rate and keep their money invested, potentially yielding greater returns. The saying, "it takes money to make money," holds a great deal of truth. It's notably easier for wealthy individuals to amass greater wealth because they have access to capital. This access allows them to seize more investment opportunities, expand their financial portfolios, and take advantage of ventures that can yield substantial returns. While Dave Ramsey's conservative approach may offer security and slow, steady growth, those with access to capital can leverage it to accelerate their financial success and make larger strides toward building wealth. For wealthy individuals, having access to debt offers a unique advantage. It's akin to having a cash reserve, but without certain downsides. The main drawback of hoarding cash, such as in a savings account, is that its value can diminish over time due to inflation. Rich individuals appreciate having lines of credit and the ability to borrow funds because it grants them the agility to seize opportunities as they arise. Borrowing often proves preferable because it removes the need to liquidate assets or reshuffle finances when making a purchase. Quick asset sales prompted by opportunity can lead to losses or adverse tax consequences. Interestingly, individuals with substantial debt loads often welcome high inflation. The reason is simple. Inflation gradually erodes the real value of their debt. Essentially, inflation enables borrowers to repay lenders with money that's worth less than when initially borrowed. Over recent years, many people have been keen on borrowing funds, particularly because interest rates have been exceptionally low, making the cost of borrowing almost negligible. This approach aligns with a broader strategy used by wealthy individuals who aim to optimize their financial positions. Access to debt serves as a powerful tool for capitalizing on opportunities, maintaining liquidity, and potentially mitigating tax burdens. While the concept of accumulating debt may seem faulty, when managed strategically, it can be a valuable asset in the pursuit of financial growth and stability. particularly for those who can leverage low interest rates to their advantage. When you're borrowing money at a 3% interest rate and facing an inflation rate of around 9%, it may initially appear that borrowing is a costly endeavor. The interest paid over the course of a 30-year mortgage or a 6-year car loan can indeed seem substantial. However, a closer look reveals that when accounting for inflation, borrowing money is not as expensive as it appears. Many loan types involve a gradual reduction in the outstanding balance with each payment made. Month by month, the balance diminishes until it is eventually paid in full, although this isn't always the primary goal. Wealthy individuals view this reduction of the principal balance as an additional benefit of borrowing money. In most cases, it's considered a bonus, an extra perk. At the outset of many loans, such as a home mortgage, you'll notice that the principal balance hardly decreases because the majority of each monthly payment goes towards interest. The pace of principal reduction starts to pick up over time, but it remains an added bonus for the most part. While principal paydown is appreciated, it doesn't hold nearly as much significance as the benefits stemming from inflation's impact on reducing the debt's real value and the power of leveraging borrowed funds. In essence, for rich individuals, borrowing money is not just about the interest rates or the gradual decrease in the outstanding balance. It's about leveraging the favorable aspects of borrowing, including the erosion of debt value due to inflation. By utilizing these financial strategies, they can effectively manage their resources and optimize their financial positions, ultimately working towards greater wealth and prosperity. Debt is a two-sided tool, and individuals who lack emotional preparedness may find it wiser to remain debt-free, following the Dave Ramsey approach. Ramsey's principles are generally reliable, but wealthy individuals harbor a strong affinity for debt, as outlined earlier. When managed judiciously, debt can accelerate wealth accumulation significantly. Keep in mind the advantages that draw successful individuals to borrow, and use this insight to enhance your financial choices. Please subscribe to my channel, like this video, drop a comment, and share.